So you define your company, define their liabilities, define their asset allocation. You create a swap using the SWPM and the Excel duration and convexity calculator. And then the next thing you're going to do is you're going to start running scenarios. Now, how are you going to do that? Well, you have your stocks. What scenario is going to run the stocks? I would say find a Vanguard mutual fund and get the adjusted price monthly back as far as you can. All right, so that'll be your historical simulation for the stock market. So what can you do with Vanguard? So I'm going to go to Vanguard's site and just show you www.vanguard.com. And then you can click on personal investors. And the nice thing about Vanguard's site is they show you the initiation date of all their mutual funds. So you just come down here and say browse their complete mutual funds down here at the bottom. And what we need is a stock fund. You can use the S&P 500. I think I don't think their total stock fund goes all the way back. So you're going to need something for the stock market, something for short-term, intermediate-term bonds, and something for long-term bonds. Okay. Well, fortunately, they have it. So we don't need tax exempt, right? That doesn't make sense because we're in a pension plan. So here's our bonds. See over here the initiation date. This one has a lot of history, but it's not the right. No one's going to use Ginnie Mae's, right? Because pension liabilities have a lot of positive convexity. Ginnie Mae's have negative convexity. That'd be a terrible asset allocation. So we'll go down here. That one goes back to 91, but not so great. Here's one back to 86. There you go, long-term treasuries. You could use the VS STX as one of your scenarios if you wanted to. It's treasury, so it's not so great. Let's see if we can find something better. Here's something back to 1987. No, that's not a good one. 1993. It's looking better. Look at this one. This looks like a really good, promising one. Back to 1973, it's long-term investment grade. So remember, one of your scenarios was 25% stocks, 75% long-term bonds. So what portfolio was that? VWESX. That'd be a great one to use for the long-term bonds, wouldn't it? So there you have one of your asset returns. We'll show you how to get that number. So we need something for stocks, and we need something for shorter term bonds. Here we go, short term investment grade. Back to 82, VFSTX. Y'all remember that because I'll forget it. VFSTX. Did I get that right? Yeah. So I realize pension plans don't use short term bonds, they use intermediate, but that's going to be close enough to get you something to work with. All right, so what are we left with? We only need one more thing. We just need stocks, right? So what would we use for stocks? So we go down under stock funds. Look over here for our, here's 1992, not too good. 88, no. 86. Large cap blend, that's a possible one. What does blend mean? It's growth and value. I don't know why I can't copy it. VQNPX. Maybe. We'll see. We might be able to find something better. 1968, that's large cap growth. That's probably not going to be good. 1959, large cap growth. No. 1958, the Windsor. Possibly. Large cap value. 1967, small cap growth. That's too specialized.
Are you looking for a blend?
Yeah, I'd like to have something that's large and small together, or international, but they don't really have anything like that. So like their total stock, like here they have global equity, that'd be perfect. But it only goes back to 1995. So probably your best bet is. So which one?
Short-term investment grade?
Well, we already got the bond piece. So here we're just looking for the stock piece. So yeah, you don't want one that's growth or value because that's just going to give you too much of a skewing toward one strategy. So probably the best one is the one we just did. Now I know you can go to Bloomberg and you can get monthly total returns for the S&P 500 back to whenever. The problem is you can't get that into Excel. It just doesn't work. So it's very frustrating. Now you can go to Bloomberg. I mean, you can go to Yahoo Finance and get the S&P 500 index itself way back. The problem is that's a price-only index. You don't have any income. Now another approach that you can use if you go into the stock market, if you don't go back further, is to use the Robert Shiller. His approach, he goes back to 1871. He has the price and he has a dividend, so you'd have to figure out your total return yourself. So, but that's possible as well. But I think this is probably good enough. We're not trying to get perfect. This is it's large cap and it's US, so you don't really have what pension plans really do, but it's close enough to do the type of analysis we want to do. So we got everything we do. We now have the interest rate swap. So the last thing we need, the price to interest rate swap, what do you need? You need changes in interest rates. Where do you get that? Well, that's really, really simple. You just go back here, historical data. Okay, come on. Here's your interest rate swaps down here. We're doing a 30-year. You can do annual. See how far back we can go. It doesn't go back very far, only to 2000. How can you go back further than that? Well, what I would recommend is you got the 30-year here, go back and get the 10-year annual. Bring that over. I'm going to line up the swap with the 10-year, go to 2000. Let's first see if there's any relationship between the 10-year swap. Do y'all think there will be a relationship?
It looks like there is a little bit.
I think there's going to be a pretty high one. We'll see. See what I know. Yeah, 0.99. That's a pretty high one. All right, so how could you do that? Well, what we're looking for the price to swap, remember, is the change in basis points. You can't say the swap is 693 if you're starting at 216. So what you're looking for here is not a scenario on what the actual interest rate is, but what the change in interest rate is. So you just take the change every year. And then what do you do when you get back here? You substitute the treasury, right? So here, you just say, well, the treasury changed that much. And you just let the treasury be your scenario after that point. However far back you need to go. You can go back to 1962. Now see what I'm doing there? So how do you run this scenario? Well, you're just going to run, let's say you go back 20 years. So here's the scenario, minus 88. How are you going to reprice your swap if interest rates fall 88 basis points? Well, guess what? Guess what I do here? Plus that, minus 0.0088. There's your repriced. You put that in portfolio. So what do you have? You have stocks. If the Vanguard fund fell 23%, guess what happens to your stocks? They come down 23%. If your Vanguard bond fund was up 7%, guess what your bonds did? They go up that. And what do you do with your swap? Well, if the swap rate was down 88 basis points, your swap went from 1183 to 1142. You put those three things together. Remember on the pension plan, we count the swap as part of the assets. Y'all remember that? For banks, we count it as part of the liabilities, but for pension plans, we count it part of the assets. So if the swap is up $300 million, you just add $300 million to your pension plan. And then what do you do for the pension liabilities? Well, pension liabilities are priced off of the BBB corporates. So you just bring that in on an annual basis. And again, you just take the change. So let's say, what was that year I did the minus 88? Let me get rid of that. 2008. So what happened in 2008? It actually went up 96. Y'all remember this? That was the year we did so well because my swap went up and my liability went down 96 basis points. So y'all remember this spreadsheet? This is actually the spreadsheet of my liabilities. So if my discount rate was 5%, but interest rates go up 96 basis points, what happens to my liability? It goes from 10828, it falls, goes from 1183 down and falls to that, all right? So what do you need to do? You're gonna run scenarios, and you can do it on an annual basis. You're gonna price the stocks off of the adjusted, the change, the adjusted price, the Vanguard stock fund. Everybody understand that? Let me show you that. Let me show you that. What was the Vanguard fund? VQNPX. So I go into Yahoo Finance. I type that in. Here's my historical prices. You can't do annual here, unfortunately, but that doesn't really matter. That's not going to hurt you that much. I do it on a monthly basis. That's the best I can do. I've done this before having y'all get these adjusted prices. I go down and download it to a spreadsheet. And which price do I want? Adjusted close, you can get rid of everything else. I don't need all that because I just need annual. And one way I do it, y'all can figure out how to do it yourself, but what I do is equal if year, let me do it, let me sort them first. I'm going to sort it from earliest to latest. So I'm going to say equal if year equal year comma 0 comma 1. And Bill Gates doesn't like that. I don't know why. If year 83 equals year 82. Alright, that for some reason didn't work. Equal year. Am I doing it right? I hate doing this with the. So does that equal that? No, it should give me a 0. Oh, I did it backwards maybe. All right, so 0. So what is it going to give me a 1 on?
The same year.
If it's the same year. I'm doing it backwards. All right, let me try this again. Equal if year equals the next year equals year there, comma 0